the rates will be set by the market, not by the central banks. I mean, there's no doubt that what the central banks want to do is to get rates down. I mean, if the Fed could somehow manage rates lower and at the same time fund the US government deficit, then they will be very cheerful about everything. But the reality is they can't get rates down. Why? Because the market is telling them, you've got a debt problem. And that is actually going to set the whole thing. There are two basic drivers of interest rates. The first is the foreigner's view of your currency. And that is desperately important. And that is what we have been concentrating on when we talk about, is dollars going down rather than gold going up. And the second is that when banks turn cautious, then they will only lend at higher rates if they lend at all. The problem the banks have, specifically this time round, I mean, it's a fluctuation that happens as part of the lending cycle. It's a 10-year lending cycle, which you can trace all the way back to whenever statistics were sort of semi-reliable. But basically, the banking systems are over-leveraged compared with where they would like to be. I mean, typically, many of the G-SIBs, the global systemically important banks in Japan and also in Europe, are up to 20 times leveraged. By that, I mean the relationship between total assets to equity. Now, that sort of leverage basically means that it doesn't take very much in the way of losses on your balance sheet to wipe out your equity. And of course, this is a topic which American investors have been made very much aware of with the commercial real estate situation, where values have collapsed and banks have outstanding loans. And they've got, they were lending as if it was a normal mortgage, sort of 80% loan to value type deal. Yet the values have collapsed to, 30-40% of what they were. So banks have got huge potential losses, which they're finding extremely difficult to deal with. That is, so they're not in the business of lending money cheaply anymore. Yet they realize that if you get higher interest rates, then the zombified economies, which they have been encouraged to finance and have also, walked into, these zombie companies are going to go bust. And even at anything a little lower than current rates, that is a process which is ongoing. This is we're going to find more and more businesses going bankrupt at anything like these levels. I mean, it's possible that the Fed might be able to lower rates by 0.25% or something like that, but I very much doubt if they'd even achieve that. And I would have thought that if they tried to do that, then the consequences would be even higher rates down the road. I mean, the idea that inflation is over, and which is the common story in the investment community throughout the world. I mean, of course, it's not over. The idea that the purchasing power of the dollar, sterling, euro, whatever, is going to stabilize when governments are running massive deficits. In other words, there is more and more currency being created, diluting the purchasing power of existing currency. And then on top of that, you've got the subjective value placed on currencies in this situation by foreigners. I mean, there's only one way for this to go. I mean, and it's not good.
Let's start by understanding why the rates in the market, particularly interest rates, are not set by central banks but by the market itself. There's no doubt that central banks, including the Federal Reserve, would love to lower rates to fund government deficits more easily. However, the harsh reality is that they can't do it. The market is signaling a severe debt problem, and that message is clear. Rates are dictated by market forces, not central bank whims. Two primary drivers influence interest rates. First is the foreign perception of your currency. When foreigners lose confidence in a currency, its value declines, pushing interest rates higher. This is critical when considering the dollar's current situation. The narrative often focuses on the dollar weakening rather than gold appreciating, but the two are interconnected. The second driver is the behavior of banks. When banks grow cautious, they lend at higher rates if they lend at all. This cautious approach is especially prevalent now due to the over-leveraged state of many global, systemically important banks, GSIBs, particularly in Japan and Europe. These banks are leveraged up to 20 times their equity. In such a fragile state, even minor losses can wipe out their equity, making them extremely reluctant to lend cheaply. Consider the commercial real estate market in the United States. Values have plummeted, leaving banks with substantial potential losses on loans that were once considered safe. These losses make banks even more risk-averse, further tightening the lending environment. Higher interest rates pose another problem: the rise of zombie companies. These are firms that only survive because of low interest rates. As rates increase, these companies struggle to stay afloat, leading to more bankruptcies. While the Federal Reserve might try to lower rates slightly, the market reality is that sustained lower rates are unlikely. In fact, attempting to do so could lead to even higher rates down the line due to inflationary pressures. Now let's address the misconception that inflation is a thing of the past. The purchasing power of major currencies like the dollar, sterling, and euro is far from stable. Governments continue to run massive deficits, pumping more currency into the economy and diluting the value of existing money. Moreover, the subjective value placed on currencies by foreigners exacerbates this issue. This brings us to China. The Chinese government, along with its partners in the Shanghai Cooperation Organization and BRICS, is actively working to reduce reliance on the dollar for trade. This geopolitical shift has significant implications for the global financial system. Chinese nationals face unique challenges. They can't easily hedge against their currency, the yuan, except by buying gold and silver. Household savings in China are estimated to be 35% of GDP, equivalent to $6 trillion annually. With limited investment alternatives like property and a fluctuating stock market, many Chinese are turning to certificates of deposit and gold accounts offered by banks. These gold accounts are fascinating. For as little as 500 or 600 yuan, about $75 to $80, individuals can open an account linked to the gold price. Banks might operate fractionally reserved systems for these accounts, but they are far more cautious with gold than with fiat currencies. The demand for gold in China is evident not just through these bank accounts, but also via the Shanghai Gold Exchange and the Shanghai Futures Exchange. This growing interest reflects a broader trend. The financial system in China is increasingly oriented towards gold, driven by a mountain of household savings seeking refuge from currency devaluation. The value of gold and silver remains steadfast in an uncertain world. Central banks might try to manipulate interest rates, but market forces and economic realities often override their efforts. Meanwhile, global shifts in currency dynamics and investment behaviors, particularly in China, underscore the timeless appeal of precious metals. Before we move to the second part, let's take a moment to appreciate a key point. The intrinsic value of gold and silver doesn't just come from their scarcity or their physical properties. It's also deeply rooted in human psychology and history. For millennia, these metals have been symbols of wealth, power, and security. From ancient civilizations to modern economies, gold and silver have always been trusted to preserve value, especially during times of crisis. Consider the gold coins minted in ancient Rome, or the silver pieces used in medieval trade. These weren't just pieces of metal, they were tools of commerce, symbols of stability, and stores of wealth that transcended generations. This historical continuity reinforces the psychological confidence that investors have in gold and silver, even in today's digital age.
Only reason for holding a foreign currency is because you expect it to go up in value or you have a particular use for it. You do not use it in the course of your normal day-to-day living. This is why the foreigners are selling it. Now, if we look at the Chinese situation in particular, we can add two further layers onto the problem. The one is the determination of China and its partners in the Shanghai Cooperation Organization and also BRICS to do away with using the dollar or depending on the dollar for their trade. The trade between them, the purchases of commodities, let's say within their club, their sphere of influence, they want to do away with that. So that's the first thing about it. The second thing in particular is that Chinese nationals cannot hedge out of the Chinese yuan through any other mechanism other than buying gold and silver. Now, this is important because household savings are reckoned to be 35% of China's gross domestic product. That is the equivalent of $6 trillion. That is being saved annually by households. What are the investment alternatives? Well, property. Yesterday's story. You can scrub that one. The stock market. The stock market has looked better this year, but this is after 3 years of falling and significant falls, and consequently that is not likely to appeal to a general public, except in a very marginal sense. This is why, up until now, what they have been doing is putting their money into what are called certificates of deposit, which in China is a slightly different thing from what we know as certificate of deposit. A Chinese certificate of deposit is basically a savings account offered by a Chinese bank to Chinese savers, which allows them to lock in their savings for up to 3 years at an enhanced interest rate. So that is just about the only investment alternative to property, which is yesterday's story, and stocks, which has very, very limited interest. These banks, however, also offer gold accounts. Now, what this basically means is that any individual who has a figure like 500 or 600 yuan, so we're talking about $75 to $80 equivalent, can open a gold account. Now, that gold account basically will pay him in yuan linked to the gold price. So what does the bank do? Well, the bank, I suppose, can run a fractionally reserved system on the gold accounts, and I'm sure to an extent they do. But I don't think they're going to run a fractionally reserved account system in terms of gold liabilities to the extent that they would with a fiat currency, over which the central bank has some control, considerable control, and can bail banks out if things get difficult. So generally, and particularly when you see the gold price being firm, when you see the demand for gold, not just through these banks, but also through deliveries, or what they call withdrawals from the Shanghai Gold Exchange, and also growing speculative interest on the Shanghai Futures Exchange, you can see that as far as the entire financial system in China, that is now angled towards gold prices, which are going to go higher and higher and higher, driven by this mountain of accumulated household savings, which sees gold as the way of getting out of their own currency.
China's determination to reduce its dependency on the dollar is a critical piece of this puzzle. Alongside its partners in the Shanghai Cooperation Organization and BRICS, China is actively pursuing a strategy to conduct trade and settle transactions without relying on the dollar. This move aims to insulate their economies from the volatility and political risks associated with the dollar-dominated global financial system. Let's put this into perspective. The combined economic power of BRICS nations, Brazil, Russia, India, China, and South Africa, is immense. By shifting away from the dollar, these countries are not just making a political statement, but also taking a practical step to secure their economic futures. This shift has significant ramifications for global trade and finance, and it underscores the growing importance of gold and silver as neutral, universally accepted stores of value. One of the driving forces behind this shift is the desire for financial sovereignty. By reducing reliance on the dollar, BRICS nations aim to protect themselves from external economic pressures and sanctions. Gold and silver, with their intrinsic value and historical stability, offer a reliable alternative. As these nations accumulate gold, they not only diversify their reserves, but also signal a vote of confidence in the metal's enduring value. The increased demand from central banks in emerging markets is a testament to gold's pivotal role in the new economic order. Now let's turn our attention back to China. The vast household savings in China, estimated at around $6 trillion annually, are increasingly being channeled into gold. This trend is driven by limited investment alternatives and a strong cultural affinity for gold. Chinese banks offer gold accounts, allowing individuals to invest in gold with relatively small amounts of money. This democratization of gold investment has significant implications for global gold demand. As more Chinese households turn to gold, the upward pressure on prices is likely to continue. The Shanghai Gold Exchange plays a crucial role in this ecosystem. It provides a transparent and efficient platform for gold trading, further cementing China's position as a key player in the global gold market. The growing speculative interest on the Shanghai Futures Exchange also indicates a robust appetite for gold investment in China. But what does this mean for you, our viewers? The strategic moves by nations like China and the broader realignment of global financial systems highlight the importance of gold and silver as essential components of any investment portfolio. In times of economic uncertainty, these precious metals offer a hedge against inflation, currency devaluation, and geopolitical risks. The narrative that inflation is under control is misleading. As governments continue to run massive deficits and central banks print money to finance these deficits, the purchasing power of fiat currencies is eroded. This reality makes gold and silver more attractive as stores of value. Silver, often overshadowed by gold, deserves a special mention. It has unique industrial applications, from electronics to renewable energy technologies. This dual role as both a precious and industrial metal positions silver uniquely in the market. As technological advancements drive demand for silver, its value is poised to rise alongside gold. The investment case for silver is compelling. Its relatively lower price compared to gold makes it accessible to a broader range of investors. Moreover, its industrial demand provides a cushion against market volatility. To illustrate the practical benefits of investing in gold and silver, let's take a humorous detour. Imagine you're on a deserted island with a suitcase full of paper money. It won't be long before you realize that the paper is only good for starting a fire. Now replace that suitcase with one filled with gold and silver coins. Suddenly, you have tangible assets that can be traded for goods and services. This analogy, though lighthearted, underscores a critical point. Gold and silver have intrinsic value that transcends economic cycles and financial crises. They are tangible assets that retain value, offering a sense of security that fiat currencies simply cannot match. In conclusion, the strategic realignments by nations like China, the ongoing geopolitical shifts, and the inherent instability of fiat currencies all point to one undeniable truth. Gold and silver are more relevant today than ever. Whether you're looking to hedge against inflation, diversify your portfolio, or simply preserve your wealth, these precious metals offer unparalleled stability and value. And let's not forget, investing in gold and silver isn't just about protecting wealth. It's also about understanding the larger picture. By owning a piece of history and a universally recognized store of value, you position yourself better for future uncertainties. Thank you for joining us on this journey through the fascinating world of gold and silver. Stay informed, stay invested, and most importantly, stay golden. Until next time.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.